Republicans in the United States Senate passed a package clawing back $8 billion in foreign aid funding and $1.1 billion intended for public broadcasting. The package codifies Department of Government Efficiency DOGE cuts into law, eliminating what some had described as fat waste and corruption. The package goes back to the House of Representatives for approval. Hello, this is Bode Oshosami, and welcome to Global Business Insights, where we go into more depth on headlines moving markets all over the world. Nigeria's headline inflation rate fell for the third straight month in June to 22.22% year-on-year from 22.97% in May. Month-on-month CPI was 1.68%, higher than 1.53 recorded in the May print. The Central Bank Monetary Policy Committee meets next week, and while most analysts do not see a strong case for a rate cut, we could see some signaling of easing, while others see the possibility of a very modest shaving of interest rates. Leading economist Opeyemi Agbaje looks at the data and comments on implications for the MPC in more detail.
There are positives and there's causes for caution regarding the June inflation data released by the NBS. Obviously, it's a good thing that inflation has declined again in June from 22.97 in May to 22.22 in June. A drop of 0.75, 0.76%. And also that it continues the positive trend of declining inflation for over the last 3 months. The cumulative decline in inflation since the basing of the GDP comes to 2.26%. That's modest but positive, and when we talk about the MPC meeting, may end a small decline in the monetary policy rate, but we'll look at that later. And so those are all positives. The causes for caution. I think that over the last 6 months, post rebasing of the CPI, the evidence, the rate of decline suggests that inflation is somewhat sticky. It's not falling rapidly, it's edging downwards cautiously, and buttressed by the fact that in this month's case, the month-on-month CPI was actually higher than in May. So in June, the CPI, the month-on-month CPI was 1.68% versus 1.53% in May, an increase of 0.15%. So that suggests that the battle with inflation is not yet won. There are causes for concern, and there are reasons to be inclined to support the CBN's caution regarding the inflation. So there's a slow rate of decline over a 6-month period, 2.25, which is modest, which is okay, but it suggests that the inflation figures, like I said earlier, are quite sticky. In terms of food inflation, 21.97% in June, versus, if you look at month-on-month food inflation, 3.25 in June versus 2.19 in May, another cause for concern. Because that means on a month-on-month basis, the food inflation figures actually went higher. There are wide divergences between the food inflation on a state-by-state level. If you look at Borno State, for instance, is at 47.40, which is which is alarming. And you might attribute that to conflict in the region. But then there's a different pattern when you look at the other states with high food inflation. Ebonyi State, where to the best of our information there is no conflict, and Bayelsa State, also fairly small and stable state. I think that suggests that the factors are different. There are local differences in the explanations for the high food inflation in different regions. I think you might narrow down the explanations to insecurity, level of food production, and transportation and logistics costs imputed into the price of food. On the other hand, the lowest food inflation states are Katsina, Adamawa, and Sokoto, all in the northwest and northeast, relatively safe, even though we know there's significant conflict in Katsina State as well. So like I said, the drivers differ from state to state or from region to region around insecurity in some cases, the high volume of food production in some cases, and then transport and logistics issues in some other cases. So what does all this mean for MPC, the Monetary Policy Committee, decision making? So like I mentioned earlier, the MPC will look at the continuous drop in the inflation figures, the 2.2% cumulative drop since the CPI rebasing, and they will also look, of course, at this month decline and feel that there's some cause for some easing, a modest easing. On the other hand, some will argue with some justification, like I've said, that inflation appears to be sticky. The declines are slow and modest, and the month-on-month figures in particular will give cause for caution. Overall, I would think that, as I hinted earlier in this conversation, there's no cause to be bullish about easing, but maybe there's some justification for a slight signaling downwards of the inflation figures, of the monetary policy rate. That would be my overall sense. A less than 1% drop in interest rates may also have some positive effect on outputs and growth.
Now to more business news. First, in the UK, payroll employment dropped for the fifth consecutive month in June, and wage growth also slowed. This is seen as the latest sign that the government's increase in national insurance contributions is hurting the jobs market. Employers have cut staff in 7 of the 8 months since the announcement, which also came with a rise in the minimum wage and global trade tensions. The Office for National Statistics said employers cut headcount by 25,000 in May, revising the previous estimate of 109,000 decline. Latest June estimates showed a further decline of 41,000 that would leave staff numbers down by 178,000 or 0.6% over the past year. This also comes as Dave McKay, the chief executive of Canada's largest bank, which has a large wealth management business in the UK, warning that a new wealth tax would worsen the exodus of rich people from Britain following the abolition of the non-dom domiciliary regime as people leave for a lower tax jurisdiction. And in the US, retail sales increased 0.6% last month after an unrevised 0.9% drop in May. US retail sales rebounded more than expected in June, but some of the increase also likely reflected higher prices for some goods exposed to tariffs. So far, corporate quarterly earnings releases and the latest US economic data are boosting confidence, investor confidence, and helping sentiment. Earlier yesterday, we saw Wall Street's main indexes rising to new closing records, supported by upbeat results from PepsiCo and strong retail sales data pointing to a healthy consumer. We also got more positive news in the job market. Initial jobless claims for the last week came in at 221,000, below the anticipated 235,000, pointing to steady job growth in July. The Nasdaq also advanced, posting a record close as the AI trade continues to be buoyed by relaxation of chip export restrictions affecting trade with China. PepsiCo, the snack and beverage giant, closed up 7.45% yesterday after it announced a second quarter beat on both top and bottom lines. Earnings were $2.12 per share on revenues of $22.73 billion versus the $2.03 per share expected, and $22.8 billion of revenue also expected. Pepsi now expects full-year core earnings per share to fall 1.5%, compared with a 3% decline expected previously. PepsiCo, like rival Coca-Cola, sees the shift in demand to healthier drinks and snacks and is now offering options such as in recently acquired prebiotic soda brand Poppi. Pepsi is also rebranding many of its products to have no artificial colors or flavors. Netflix second quarter earnings beat on both top and bottom line as revenue grew 16% more than expected in the quarter. Earnings per share was at $7.19, while revenue at $11.08 billion was just slightly over $11.07 billion expected. Netflix did not report on subscriber count as it continues to focus more on financials and user engagement. In a statement, Netflix increased full-year revenue forecast to between $44.8 billion and $45.2 billion, up from a range of $43.5 billion to $44.5 billion. This, they say, was due to a relative weakening of the US dollar, helping member growth and strong ad sales. Netflix closed up 1.91% just before the announcement, but dropped soon in after hours as traders apparently were expecting better. Also in the US, Fed Governor Adriana Kugler signaled that rate cuts are off the table for now, adding that Trump-era tariffs are starting to push up consumer prices and that tight monetary policy is crucial to hold down inflation. But Mary Daly, another FOMC member, however, also said 2 rate cuts this year remains reasonable, with the first in September looking more likely and not July. All this as attention is focused on the August 1 deadline threatening higher tariffs. The US said it is close to trade deals with India and Europe. Uber is taking a $300 million stake in US electric vehicle maker Lucid in a deal that will see the ride-hailing platform launch its first robo-taxi fleet. Uber would buy at least 20,000 vehicles from Lucid and become its second largest shareholder after the Saudi Public Investment Fund. Lucid shares closed up a whopping 36%. Crude oil inched up. Brent was up 1.5% after signs of tightening in supply. Iraq said it had lost about 200,000 barrels a day of oil production due to drone attacks on several fields in Kurdistan. Asian shares mostly higher, tracking Wall Street as economic data showing US resilience and robust corporate earnings offset tariff worries. Well, that's it on this episode of Global Business insights. Do enjoy your weekend. This is Bode Oshosami. Thanks for watching. Bye-bye.